Alright class, we are finally here, the end of the accounting cycle. So we're going to start chapter 10 now, and it's pretty much working on our closing entries and closing out our books for the month. If you take a look at the cycle here, we pretty much completed all these steps. Collected, verified our source documents, we analyzed, we then moved it into the general journal, that information, then we posted to the ledger, complete our trial balance, our worksheet, all our financial statements we did in the last chapter, and now what we have to do is we have to close out our books. We have to bring all of our temporary accounts to zero. Alright, so closing entries. These are journal entries made to close or reduce to zero the balances in all of our temporary accounts. Alright, our temporary accounts are our revenue, our expenses, and our withdrawals. Remember, through the entire month we keep track of how much it is that comes into those accounts, and then at the end of the month we report those balances back to capital and we start over again at zero. Okay? So here's the other account that we're going to use. It's called income summary. And this is a general ledger account used to summarize the revenue and expenses for that time period. Basically what we're doing is we're taking the balance of revenue and we're passing it along to income summary, and then income summary is passing that balance along to capital. We're taking the balances of all of our expense accounts and we're passing it to income summary, and then income summary is taking the balances of our expense accounts and it's passing it along to capital. Okay? Income summary serves as a simple income statement for the ledger, right? Meaning, because we keep our revenue balances and our expense balances. Revenue and expenses is pretty much what's on our income statement. They're used to accumulate revenue and expenses for that period, and it equals net income or net loss for that period. So the difference between your revenue and your expenses, that's the balance that ends up staying in your income summary account. Some other rules for income summary is used only at the end of the accounting period to summarize revenue and expenses. Okay, so you only use it at the end of the accounting period. It does not have a normal balance, right? The balance is whichever side is larger. So your credits would represent your revenue. So if you have a net income, your revenue balance, income summary is going to have a revenue balance. But if your expenses are greater, you have a net loss, and it would have a debit balance. So it doesn't have a normal balance. It depends on what your net income or net loss is for that period. It has a zero balance before and after closing. So it starts the month with a zero balance. It just takes those balances from expenses and revenue, passes them along, and then it has a zero balance once again. And it does not appear in any of the financial statements. It's just a tool used to transfer expenses and revenue balances to capital, and then it goes away again. Okay? So the way that you set up your closing entries. One, you have to enter closing entries on the top of your general journal. So you're going to use your normal general journal page to record your closing entries. You write closing entries on top, and then you would enter the last day of the accounting period. Okay? So whatever the last day is of the month, or the quarter, whatever it is, that's the date that you're going to use. These are what your balances were in your temporary accounts the last day of that period. Okay? Then enter the names and amounts of the accounts to be debited, and then you would enter the names and the amounts of the accounts to be credited. Okay? Income summary is used to transfer those balances back and forth. So let's take a look at it. It's easier if you look at it. So there are 4 entries that we have to do at the end of the period to close out our books for the month. The first one is that we have to close our revenue account. Okay? So again, remember, we're passing our revenue balance over to income summary. So we would look and see on our worksheet what the balance of our revenue accounts are. Now the normal balance of a revenue account is credit. So if you want to take something that has a credit balance and make it zero, you have to debit it. So if we went and we found, we could see here that our revenue account has a balance of $2,650, and it's on the credit side. So in order to bring that balance to zero, we need to debit it for $2,650. If you look now, there's a zero balance in delivery revenue, right? They cancel each other out. So if we just debited delivery revenue for $2,650, well now we have to go and credit another account. Remember, every single transaction, every occurrence has to have an equal debit and an equal credit. So because we debited delivery revenue to make it zero, we now have to go ahead and here's that other account, income summary, and we have to credit it for the same amount, for $2,650. So now we're in balance, we just debited delivery revenue, $2,650, and in income summary, we credited $2,650. But now we have to take this information, we have to post it, right? We have to put it in our general journal. So like I said, the first thing you have to do for closing entries is write the term closing entries on top. Next you have to put the last day of the month. So in this case, it's October 31st, the end of October. We always start with our debited account first. So when we look at these two, we see that we debited delivery revenue, $2,650. So we write delivery revenue, $2,650, $2,650, and now our credit account. We credited income summary, $2,650. So you would write income summary and credit. That's it. We just reduced our revenue balance to zero, and we just put that information, we journalized that entry in our general journal. That's the first closing entry. We took care of revenue. The next accounts that we have to take care of are expense accounts. And same thing, we have to reduce all these balances to zero. So if we look at all of our expense accounts for this time period, we see they all have debit balances. Advertising expense, 75, rent expense, 700, maintenance, 600, utilities, 125. Because they all have debit balances, and the idea is that all those temporary accounts go to zero, we need to do the opposite, we need to credit them. So we would credit advertising expense, $75 to bring it to zero. We would then credit maintenance expense, $600 to bring it to zero. Rent expense, $700 to bring it to zero. And utilities expense, $125 to bring it to zero. So we basically took all of our debit balances and just did the opposite to bring those accounts all down to zero. But remember, we use income summary now to pass that along to. So if we credited all of our expenses, in order to balance out, we have to go ahead then and debit income summary for the full amount of all of them when we add them up, okay? So we're going to debit income summary $1,500. And the reason why we debit it for $1,500 is because when we add 75, 700, 600, and 125, we get 1,500. So remember, you don't have to have an equal amount of accounts that you debit and credit. The balance just has to equal. So we have 1,500 on the debit side for income summary, and the total credit would be the total, it would be all of our expenses that we brought down to zero, okay? Expenses now have a zero balance, and we just passed along a $1,500 debit to income summary. Let's look at the transaction. So we're still on the same page, the closing entry page. Again, we would put the last day of the month, and now we put our debited account first. In this case, we debited income summary $1,500, right? That was the total of all of our expenses. Our credited accounts now are just all of our expenses, the ones that we brought down to zero. So you just simply list them and write the credited amount. List them and write the credited amount. This is what's called a compounded entry, okay? You see, we have 4 accounts that we credited and only 1 account that we debited. That's okay as long as the total of all the accounts that we credited equals the account that we debited. In this case, it does. All of our expenses that we credited equals $1,500. And that's what we have in income summary. So just to recap where we are right now. In the first transaction, we went and we took our revenue accounts and we credited income summary $2,650. Okay? This is our income summary account. And we debited our income summary $1,500. The $1,500 were our expenses and the $2,650 was our revenue. But now what we need to do is we need to close income summary, right? It starts with a zero balance and ends with a zero balance. So right now it has a balance. And if we look at it, we see that we have $2,650 in revenue on the credit side, and we have $1,500 our expenses on the debit side. So the balance that we would have right now is $1,150, right? $1,150 is the balance. $2,650 minus $1,500, and the reason why it's a credit balance is because we have more credit. There's more value on our credit side. Our revenue was greater than our expenses, okay? But it can't stay that way. $1,150, remember, income summary has to go back to zero. So in order to make it zero, if it has a credit balance, guess what we have to do? We have to debit it to make it zero. So we would debit income summary $1,150 to bring income summary back to zero, all right? But now, we debited income summary, there always has to be a credit. So in this case, the account that we're passing the balance over to is our capital account. So we would have to credit our capital account $1,150. So the 2 accounts affected income summary, we just brought to zero by wiping out the balance. We debited $1,150. And we passed along net income, basically, because that's what it was. Our net income, we passed it along to capital, okay? The entry looks like this, always our debited account first. So the last day of the month, we debited income summary, $1,150, the remaining balance, to bring it down to zero. And we passed along our net income, or the balance, to capital. And we know capital goes up on the credit side, net income increases our capital, so we would have to increase it $1,150 on the credit side. So this is our third entry. We've now closed all of our revenue accounts, we closed all of our expense accounts, we closed income summary. There's only one more temporary account that has a balance in it, and that's withdrawals, okay? We looked on the worksheet and we saw the withdrawals has a $500 debit balance, right? That's what the balance of withdrawals is, $500. So now if we want to make that zero, we have to do the opposite, and we credited $500. So the balance is zero right now, we just credited. In this case, withdrawals goes right to capital. So a withdrawal will decrease your capital, and if it has a normal balance on the credit side, what you would have to do to decrease it is that you would have to debit capital $500 to show that you just lost a certain amount of your assets, okay? So here we go. In order to close out withdrawals, we credited 500 and we debited capital 500. We go to our journal and we debit capital 500 and we credit withdrawals 500. Withdrawals now has a zero balance. All of our temporary accounts were brought down to zero, okay? And this pretty much completes the accounting cycle. There's 2 steps left. What you need to do then is take your journal information and you need to go post it to those accounts in your ledger. Remember, your ledger accounts still show balances in withdrawals, revenue, and expenses. So you have to take this information now and you have to go and post it to your ledger and update your balances so that they all come down to zero. Once you're finished bringing them all to zero, you then have to go and move them over to your post-closing trial balance. This is where you take all the balances in your ledger accounts, the updated balances, and make sure that all of your debits and your credits equal each other to prove that you did it correctly. Okay? And this is it. This completes the accounting cycle. You basically would start the month over again. You would begin to analyze, record, and do everything that we did just over and over again to keep accurate books. At this point, you're ready to keep track or to do the bookkeeping for a service company. So if you understand these steps as we've gone through all these chapters, then congratulations, you're on your way to being a bookkeeper, understanding the accounting cycle.